Good evening and welcome to the Money Show, the place where money stops being confusing and starts working for you. Because let's face it, every decision we make, from the coffee we buy in the morning to the home we dream of owning, from planning your next holiday to securing your children's future, has one thing in common, which is money. Yet, despite the role it plays in every chapter of our lives, very few of us were ever taught how to manage it, grow it, or make smarter financial decisions. That's where we come in, whether you're just starting your financial journey, building wealth, investing for the future, planning your retirement, or simply trying to make your salary stretch a little further. This show is your show. Every day we'll cut through the jargon and the noise to bring you practical advice, expert insights, smart investment ideas, tax saving strategies, market trends that actually matters, and real stories from the people who have transformed their financial lives. So no complicated spreadsheets, no intimidating financial language, just clear, honest conversation about the decision that can help you build a stronger financial future. This is the show where we also answer your portfolio queries. So we'll just flash our WhatsApp number, get connected, send across your portfolio details, and we will get it answered live on the show. 865-797-4571, and the email ID where you can send your question is themoneyshow@etnow.tv. All right, so let's begin the show, and we have something very interesting today. The face of investing is changing, and it's changing fast. Not too long ago, most people waited until they were well into their 30s or 40s before thinking seriously about investing. Today, that story looks very different. India's newest investors are in their late teens or early 20s. They are opening demat accounts with their first paycheck, starting SIPs before they've planned their first vacation, learning about markets from their smartphones. This is Generation Z, a generation that's digitally native, financially curious, and far more willing to invest than any generation before it. But while access to investing has never been easier, making the right decision hasn't necessarily become simpler. With social media influencers, viral stock tips, trending themes, and hundreds of investment options competing for attention, how can a first-time investor separate genuine opportunities from market noise? Should they start with mutual funds or stocks? How much risk should they really take? What are the biggest mistakes first-time investors make that could cost them in the long run? Today, we'll explore why Gen Z is entering the market in record numbers, what is driving this investment or investing revolution, and the smart principles every first-time investor should follow before putting their hard-earned money to work. Because investing isn't about getting rich overnight, it's about building wealth, one informed decision at a time. And joining me on this very special episode is Kavita, Mendon, and Abhijit, Choksi, our guest on the show, who will be also answering our Gen Z queries. Hi, good evening. Welcome both of you to the show. And I know with both of you, we've had this conversation several times, but then, just to get the lay of the land, just to begin, one very common question I'll be asking both of you. Kavita, how many Gen Z clients do you have? What are their top 5 questions? And if not a client, at your home, maybe, in your close circle.
So, will you be surprised if I said I got the most Gen Z clients only in the last
Really?
1 year?
Is it true? Wow. Interesting. A very good sign.
And it's fortunately they've all come to me because after their experience with all these platforms where they were able to buy investments, funds, derivatives at the click of a button, they kind of have come to the conclusion that it is better to have somebody guide them out of the portfolios that they have created for themselves. So a lot of Gen Zs who entered the market in the last few years, unfortunately, see, the fortunate thing is they have access, they have a very simple system to invest, which probably our generation did not have. So they can at a click of a button buy, sell, transact. But is that a boon or a bane? And what I have come to realize is that a lot of these Gen Zs have actually lost money or lost opportunities because of the way this very quick, fast investing has led to, it's not been the best thing for them. What has happened is they have been investing basis the past 3 years returns. So you will see you know, one particular fund house is heavy in the portfolio. You have some 10, 12 different investments all overlapping with each other. There is no direction. And the worst part is they panic when they need the money and there are withdrawals in the near future because they have invested thinking that this is quick money. We get 12, 15% return, aram se. But that's not the truth about the markets. And that's unfortunately hit in the last 2 years where returns haven't been that benign and not so easy to come by.
Right, right, right. So today, very interesting set of questions we've got that we'll be answering later in the show. But then, Abhijit, what's been your experience so far with the new generation or the first-time investors?
Yeah, right. So in the last few years, especially after COVID, the participation has increased quite massively. And the good thing about the Gen Z generation is that they are not biased like our elders' generation, like the generation which my parents are in. Um, I mean, I'm a Gujarati, so we used to have dinner table conversations about personal finance. But what I understand is that most people would consider stock market investing to be very risky. In fact, what I had heard that in certain households earlier, the guy would not get married because he's into stock market. So people were scared to um, marry their daughters off because there was an assumption of the risk. But now that thing is changing. The new generation is now more financially aware and they are more curious, which is more visible in the number of demat accounts we see.
Interesting. All right, so let's get started with our viewer queries, and we have got these questions from social media. I'm very excited to start shooting to, one by one to both of you. Kavita, I'll come to you first. So this is a question from Mahesh and Sambhaji Nagar. He's 21 years old and new to investing, wants to understand the difference between stocks, mutual funds, ETF, bonds, and golds. And all right, so which is the best and the safest option for him to begin with? Very interesting. I think he's laid out all the investment tools that are available, and that we also keep advising our investors depending on what investing stage they are in. But then for Mahesh, Kavita, I'll come to you, beginner and wants to understand each of these investment instruments.
So, Mahesh, the first thing that you wanted to know about is shares. Now, shares are essentially ownership of a business. You own the business. When you're buying a share of Reliance, you're a part owner of Reliance Industries. Okay. Now, because you're an owner, you have to think like an owner. You must understand the business. You have to be going through annual reports. You have to understand the factors that impact the business of Reliance Industries. When does it do well? When does it not do well? What are the overall macro factors, regulatory factors? So there's a lot of research that you need to do when you own a business directly. When you buy stocks, that's exactly what you're doing. You're being an investor in a business. Okay. And the stock market, the beauty of the stock market is it allows you to invest in multiple businesses. But when you do it directly in the form of stocks, please remember that you also must be thinking like a businessman, thinking like an investor. You have to have a very deep knowledge of a lot of things which affect the companies that you're investing in. Because a lot of us are not inherently so well informed or do not have the time. We have other careers, we have our jobs, our education, whatever to complete. Uh, you have an alternative to invest in equities via a mutual fund route. What is a mutual fund? Basically, it's a pool of investments. So a lot of investors put money, hand over money into a pool, and that pool then invests in a diversified basket of investments. Those investments could be anything. It could be equity, stocks, it could be bonds, it could be gold, it could be a defined basket of investments. All right. So the advantage of investing in mutual funds is that you are handing it over to either an active fund manager or an algorithm or a rule-based investing that will invest on your behalf. So you don't have to get into the nitty-gritties of the businesses that are being invested in. And that's a more easier way to start investing in the equity market, mutual funds. When a mutual fund gets listed in the stock market, it becomes an ETF. Okay. So it's called exchange traded fund, which means that you can buy and sell the mutual fund just like you would buy and sell stocks. Okay, so that's an ETF. You asked what are bonds? But like equity is or shares or stock is ownership, bonds represent a loan. Okay. So when you invest in a bond, you're essentially giving a loan. It could be to a corporate, it could be to a bank, it could be even to the government. In return of that loan, the government or the corporate or the bank will give you a fixed rate of return in return of your capital. Okay. So bonds typically give you fixed rates of interest, and that's how it works. Okay. The last thing you spoke about, gold. I'm assuming you're talking about digital gold because clearly Indians are used to knowing what physical gold is. So I don't think that is an issue. But you must be mostly talking about digital gold, which is in the form of ETFs or mutual funds that invest in gold. Or you would have, now there is electronic gold receipts which are available on the exchanges. So that's
Okay.
also an option.
Right.
Right. So the gold is the form of
So what's
digital
going to be
formation.
what's going to be one recommendation? What can he start with?
So there is no one answer to this, Kavita. Sorry, but I can't
Can he
say that.
start
I
with
need to
mutual
know what.
funds? Can he start with index mutual funds if he wants to know how equity works?
He starts with creating his emergency fund first, safety
Okay.
first.
All right,
Then
Mahesh, for
after
more
that, he
details, you might
creates.
want to. All right, I have a lot of questions to finish, which is why I'm just rushing.
Yes,
We'll do
okay,
a rapid
sorry.
fire.
Yes.
Okay, so
Okay.
Mahesh, emergency fund, think about, you've got to know, you've known all about your investment instruments. You want to ask how to start and what's going to be the corpus. If you are aligned with all of that information, send us your question again. Let's take Priyansh Shah's question. Abhijit, he's 25 years old and wants to build 25 lakhs. For an MBA by age of 35, can invest 15,000 per month through SIPs and current mutual fund corpus. Okay. Yeah. So he's got gold ETF, defense, mid cap, Nifty 50 and infra funds, and currently earning 10 to 15% annual returns. And how can he achieve his goal?
Right. So first, I would like to tell Mahesh is that his time is his biggest asset now, as he's 25. So he has some time on his side, so he can take some risky bets. Although I can see that he has added some thematic funds in his portfolio structure, so that is something on a higher risk side. So unless he's working in that sector and he's completely sure that this sector is going to perform for the next few years, then thematic
Abhijit,
funds
I'll
can be
just
considered.
interrupt in between. Abhijit, this is Priyansh's question that we've got through social media. And so he wants to build 25 lakhs by the age of 35. He's 25 now. And for that, he can invest 15,000 per month. And current mutual fund corpus is 2 lakhs. He's got gold ETF. He's got some defense exposure, some exposure in mid cap, Nifty 50 and infra funds. That's what the portfolio is. And 10 to 15% is the current earning through his portfolio.
Correct, correct. So yeah, I'll tell him to cut down on the thematic funds and at least go for a large cap fund and a mid cap fund to balance out his overall mix. Because right now, what I see is that he has taken a big risk by investing in highly aggressive funds, which are thematic funds. And gold ETFs he can keep on holding going forward.
Is that it?
Yes.
Okay. Kavita, what would you like to add?
Okay, so youngsters, okay, when you're just beginning your portfolio, please do not invest in the passives. In India, historically, actively managed funds have done better than the indexes themselves. So I would recommend that he moves out of his Nifty 50 investment and move to a more well-managed, either a large cap flexi cap fund or a large cap fund. Either would do better than his index for sure.
Okay, next question is for you, Kavita. This is from Rahul. He's from Mumbai, first-time investor, and wants to know the safest option to invest in his financial journey.
Safe option?
Yeah.
So, Rahul, the best, safest thing to do is, you do a fixed deposit. And if that doesn't work, then you can also invest in liquid funds. If your tax is in the lower brackets, if you are in the highest tax brackets, then I would suggest an arbitrage fund. These are safe investments and have very limited volatility. So if you're just in the beginning and you want a safer return, then these are good tools. But please remember that these tools have very low yield and they're not great for long-term investments. At best, they will meet short-term goals or for your emergency fund.
All right. It's time for a short break, but post that again, we'll be talking about first-time investor question. And just in case before that, any of our viewer want to send across their question, you can do that on our WhatsApp number and email ID. You're watching The Money Show, and this is a show where we focus on first-time investors' queries. Let's move on, and okay, let's take Akshay's question. Abhijit, this is Akshay. He's 22 years old and wants to start his investment journey, unsure whether to invest now or wait for the markets to settle. A quick answer, Abhijit.
This is a very most common. A lot of people try to time the market, so they try to ask, is it a good time? But the thumb rule is that if you are a long-term investor with 10 to 15 years of horizon, especially Akshay, you are 22, so your time is your biggest asset. So you should start in a staggered manner right away. Don't wait for the right time, because the plan here is not to time the market, but to be in the market. So I would request him to start now and first ensure that he has an adequate emergency fund and a basic insurance, and then he can start his equity journey.
Kavita, we've got a couple of fresh queries we might have not shared with you earlier, but then this is Tara. She's 20 years old. She's a college student and new to investing, dreaming of a Europe trip in 2028 and wants to know how to start investing for a short-term goal.
So, well, congratulations that you're actually saving up for your vacation.
Yeah.
And at such a young age, my God. So the best way to do it is start a SIP in a arbitrage fund. It will serve your purpose. In 2 to 3 years, you will have a good amount of returns in hand. And the taxation is much lower than, say, a liquid fund or a fixed deposit. You will be taxed only at 12.5% taxes. So start that, or if you have a 2 to 3 year, you said 2028, 29. If that's about 2 to 3 years, you can also look at an equity savings fund. That's not a bad option either.
Question for you, Kavita. This is Anya celebrating her 23rd birthday tomorrow. Well, happy birthday to you, Anya. And wants to begin her investment journey, planning a trip to Sri Lanka by the end of this year and needs around 60,000 for the trip and can save almost 8 to 10,000 per month. What's the strategy for Anya then?
Very easily, she should be there, right? She'll be home. If she's saving about 8 to 10,000, she'll be home. A simple, the same investments that I spoke about. Either you could do a recurring deposit with a fixed recurring deposit in a bank if you're not falling in the highest tax brackets. And if you are paying a hell lot of taxes, then please choose an arbitrage or an equity savings fund with, no, let's not do equity savings. There's an element of equity in them. Just choose plain vanilla liquid or arbitrage funds for doing an SIP for the next 12 months and you'll be home.
Abhijit, this question is from Ravi, Uttar Pradesh. He's 24 years old and planning to begin investing, wants to avoid common beginner's mistake and have good investment habits.
Right. So the most common mistake most people do is they don't write down their financial goals. So he should write down his goals and then reverse engineer his investment based on his goals. Other is that if the market falls, most investors, they stop their SIP in between. So that is one of the major mistakes. So I would say that, in fact, keep consistent SIP, and when the market falls, keep your extra ammunition and invest during those bear phases. Also, I would urge him to not try futures and option, because that is majority of the youth is hooked on it and a lot of money has been drowned in it. So don't even try futures and options. Just consistently focus on SIP in quality mutual funds, which we keep on discussing on the show. And make sure that the basic or emergency fund and insurance is well placed before you start into equity. That's it.
Right, let's move on. Kavita, this is Monica's question for you. She's 18 years old and from Mumbai, just starting her investment journey and worried about losing money in the market. She wants to understand how to tackle risk.
So the first lesson to know is there's a difference between risk and volatility. Okay, risk is the permanent loss of capital.
Right.
And volatility is the nature of the market, the ups and downs, which are natural in any market cycle. Okay. So if you're here, if you're going to be a trader, if you're going to do derivatives, can you lose 100% of your money? Of course, you can lose 100%. You can lose more than 100%. You can actually go negative. But if you invest in a well diversified mutual fund with a 5 year view, will you see volatility? Yes, of course, you will see volatility. There will be times where you will go into the negative. But in a 5 year period, will you still stay negative? Very unlikely. So it's all a game of probabilities. See, don't enter the markets thinking that will I make a loss? Will I make a gain? That's not the way to invest. The money it has to, it's your goal. You have to have the perspective of a long-term investor, invest in the right kind of diversified assets. And that's the way you mitigate risk. Mitigate is the reduction of risk in your portfolio. You cannot eliminate it ever. And the earlier you learn this lesson as an investor, the more your success ratio will be as you go forward investing.
Question is for Abhijit from Shefali. She's 20 years old, new to investing, wants to understand why SIPs are recommended for beginners.
Right. So SIP is a strategy where people have to just consistently invest every month. And a lot of people try to time the market. They try to invest lump sum, but SIP does what it does is that it does a mean reversion. So in case if a market is bad on a certain month, your average NAV is much better if you continue to do SIP. Now, obviously, market no one can predict short-term movements, so that's why SIP becomes more of a stable way to invest. I would start Shefali to start with at least 5 to 10% of her savings into a large to mid cap fund, and gradually do a step up of 10% every year, and tie her investments with a goal.
Next question is for Kavita, and this is from Supriyo, if I'm not wrong. Yes, Supriyo. And Supriyo wants to know if bank FDs are good for short-term goals and capital safety, and wants to understand as to what is the long-term wealth creation roadmap.
So, of course, yes, for short-term goals, FDs may not be a bad idea. They may be great for emergency funds and for short-term goals. No doubt about that. But if the roadmap is for longer-term wealth creation, these are not great investments, because in the long run, bonds, fixed deposits, fixed interest-bearing instruments don't tend to beat inflation unless you are invested in inflation-hedged assets. Now, what are the three inflation-hedged assets you have? There is equity, there is gold, and there is real estate. So these are the three asset classes in which you must have exposure for long-term wealth creation. Okay. And for each of these, you must also have a very long-term view, at least a 5 to 10 year view for investing, so that you make real wealth.
Mm-hmm. All right, I do have a lot of questions, but then I'm done with my timing for today. But thank you so much, both of you, for participating in this very important show. And looking at the response, I'm sure we'll get a show 2 or a second part of this show next week for our viewers. But thank you so much. And for our viewers, if you're also first-time investors, do send across your question on the WhatsApp number, email ID that's flashing on the screen. Thank you so much for watching.